Welcome back to Commercially Speaking, the only commercial real estate podcast where a CCIM instructor breaks down the business and his little brother slowly loses grip on reality while trying to understand it.
I'm Bo Barron, CCIM, Marine veteran, founder of Barron Commercial Group, co-founder of Hearthstone Capital, and the only one here who owns an actual cash flowing asset.
Unless you count charisma, which you shouldn't. I'm Timmy Barron, ADHD, actor, comedian, and currently in year 3 of learning commercial real estate. Not because I want to be a broker or an investor, but because somebody had to make this industry slightly more fun.
Well, you're certainly good at that.
You do the deals, I'll keep asking the dumb questions, and with a little help from Bo, we'll figure it out.
9, 8, 7, 6, 5, 4, 3, 2, 1.
Today's guest is one of those guys who makes me feel like I've spent the last decade doing, I don't know, improv in a basement.
Well, that's because you have.
Meanwhile, Kevin Dean was founding Rockbridge Investor, let's say that together all at once, Rockbridge Investment Group, stacking multifamily deals, earning his CFA, and commuting 2 hours each way, listening to real estate podcasts at double speed.
He's the kind of investor who makes smart moves quietly and makes you wish you were taking notes.
Every time I read Kevin's bio, I feel like I need to open a Roth IRA and apologize to Dad.
You can start by learning what either of those things are.
He's built a killer portfolio. He leads with vision. He actually cares about people. And I'm over here thinking debt service coverage ratio is a boring insurance company.
Well, to be fair, you also thought cost seg was a mob term until last week.
And it still might be. This guy's a rising force in CRE, and if you are not following what he's doing, you will after this.
So please welcome to Commercially Speaking,
The man, the myth, the multifamily optimizer, Kevin Dean!
Gosh, it's going to all be downhill after that. That's probably the best introduction to a podcast I've ever heard in my life.
Fantastic. I take a lot of pride in that.
Well done.
Well, welcome. How are you all connected? We were talking just a second ago that Justin Ryder might have been the matchmaker here.
That's right. You know, Justin was familiar with what we were doing at Hearthstone Capital and essentially how we're trying to raise equity and invest it in a way that's faith-forward, redemptive real estate kind of thing.
Sure.
And we're looking for sponsors to invest with. As a fund of a fund, we're not the operators. And so to us, the operator is more important than the deal itself. We got to find somebody who's missionally aligned, cares about the same things, and that we can trust. You mentioned it in the intro. Dude's 30.
Right.
30.
Yeah.
Like I was barely out of the Marine Corps when I was 30.
That's right. Yeah.
You know?
Right.
And so Kevin, what you've accomplished thus far is really impressive.
I was barely out of our parents' home at 30.
For all you guys know, I could still be living in my parents' basement. We haven't gotten there yet.
Oh, that's true. That's
true.
Which actually can be a smart move for most people that are hustling.
I am out officially.
I was going to ask you. You are. Okay, that's good.
All right, for the record.
Just so there's no confusion.
Yeah.
My parents would probably actually love if we came back so they could hang out with the grandkids, but we've branched off. So
yeah. Well, why don't you give us like a little 2-minute background story? Like where you're from, what led you into doing what you're doing now?
Yes. Quick background. I live here in Northern Virginia. Grew up here and went to school at Salisbury up in Maryland, played baseball there, and kind of always had the entrepreneurial itch growing up. Started actually with collecting golf balls on the local golf course and then selling them back to the guys who lost them.
My kids did that.
That's awesome.
Yes, it was the best. We would get like crazy
Totally.
poison ivy every single summer, just digging for golf balls. But like one summer, we literally bought an air hockey table from Costco as like a 9-year-old in 3rd grade or whatever.
That's amazing.
But yeah, always kind of had that entrepreneurial itch. Went to Salisbury, awesome experience. Met my wife, played baseball, got a finance degree, started the CFA, and then went to Fannie Mae, working on the pricing desk in the multifamily division, which basically means, I was on the team that was determining what the interest rate was for each multifamily loan. So amazing experience. We would price about $200 billion worth of loans every single year between the three of us on that team. And I got to see everything from a Blackstone deal to, some random guy out in Alaska and everything in between. And, through that process, quickly learned that, I wanted to be on the ownership side. So started just to figure out a way to make that happen through a combination of listening to podcasts, reading books, networking like crazy. Eventually kind of figured a way to get into the business and go full time with it and grow Rockbridge.
I'm very interested in this Fannie Mae.
Have you met her?
No, I've never met Fannie Mae. No, I've had her I've had her chocolate. Doesn't she do chocolate too?
It's funny you bring that up. I should know this, but you're not the first person to tell me that before.
Right. Are you looking it up?
I am. Okay.
Yeah.
So it's spelled differently.
Yeah. Okay.
Different company, but you're right. There is Fannie Mae chocolate. This is Fannie Mae, the Federal National Mortgage Association.
Right.
Slightly different.
Right.
But
well,
you're right. Yes.
Yes, I knew Fannie Mae did chocolate, and our grandma was Frankie Mae. It's a different one, same syllables and initials. But what I wanted to ask about, like, being at Fannie Mae, and you were in charge of pricing the interest rates. I mean, what kind of insight can you give that you got from that job that would benefit anybody that's investing or borrowing? Like, what kind of insights surprised you?
Yeah, I have a lot of ways I could answer that.
Hey, if you're new to commercial real estate investing, you probably know the feeling. Brokers, underwriting, raising capital, where do you even begin? And that's why CRE Investor Coach exists, to give new and emerging investors a clear step-by-step path to closing their first deal. I believe in this program so much, I actually joined the team as an adjunct faculty member. That's how committed I am to helping more people get into the space right now. Whether you want to go at your own pace with on-demand training, launch your first investment with expert coaching, or scale with a mastermind of other ambitious investors, there's a roadmap here for you. Inside, you'll learn how to define your investor identity, analyze deals with confidence, talk to brokers like a pro, raise capital, and build a real acquisition pipeline without all the guesswork. This is about building a business that blesses your life, not breaks your spirit. So if you're ready to stop spinning your wheels and actually get in the game, check out the link in the show notes and start your journey today. Learn, launch, and scale with CRE Investor Coach. This episode is also brought to you by Site to Do Business, commercial real estate's most advanced toolkit, providing commercial real estate professionals like me with premier data, mapping, and marketing tools to win business and revolutionize decision-making. Visit stdb.com to learn more.
I mean, high level, what we were doing was we were pricing the credit risk, right? So basically, if you had a really good asset, a really good borrower, low leverage, high debt service coverage ratio, and it's with somebody who's done 100 loans with Fannie Mae, you're going to get an extremely tight credit spread because the risk of that loan is lower than the flip side, which is a brand new borrower, low debt service coverage ratio, high LTV in a tertiary market, and maybe it's a 60s vintage asset and it's a value add, right? So like basically every deal we were looking at, we were weighing 25, 30 different factors to figure out, if we're going to put a certain spread on this deal, what spread are we willing to put on it to either win the deal at a good return to the company or push the deal away so that we don't win it. But if we do, we're really excited because we're making a good return on it. So it was basically a good opportunity to learn how to look at credit risk on a number of different deals.
Right.
And we were pricing, 50, 100 deals a day. So you're getting a snapshot of, the underwriter's already completely underwritten the deal. The sales team's put the package together. They've consolidated hundreds of pieces of due diligence into, a tiny box that we're then looking at. And maybe we have to do some additional research and ask questions, but essentially you should be able to figure out what is the right spread on this loan based on these factors that have been consolidated and put in front of me. And then, kind of negotiating from there. The credit risk was a big piece. The other piece too was honestly the negotiation aspect was, every single deal was a negotiation. So like I was 22 years old and I had way too much power pricing, $100 million loans. And it taught me a lot about like just how to talk to people and what really matters in a negotiation and just kind of learning that process.
All right. You just used a bunch of terms and I need to make sure that we didn't leave Timmy in the dust here. Debt service coverage ratio.
Yes.
DSCR. Are we good on that one?
Yeah.
Okay. For those of you watching from home, debt service coverage ratio. Here's the deal. You take the net operating income of the property.
Right.
Remember what NOI is?
Yes, I do.
Okay. For instance, if the DSCR is 2,
Yeah.
your NOI is twice as much as the debt service, annual debt service for the year.
Okay. Yeah.
All right. So if it's 1, all your NOI goes to the debt service. Nothing's left over.
Right.
It's like, ugh.
Yeah.
You know, never want to be in that position as a lender or a borrower. And so Fannie Mae probably had some, what was their, you know, a lot of lenders are like 1.2, 1.25, something like that. They want to see that debt service coverage. So you're making that much more over what you have to pay on the debt.
Yeah.
What was Fannie Mae's?
There's kind of standard was 125 debt cover and a max LTV of 80%.
Okay.
But they had different tiers. So
Sure.
that would be a tier 2 loan, you know, which is the most risky. And then, you know, tier 3 would be a 135 debt cover, 65 LTV. Tier 4 would be a 155 debt cover, 55 LTV. So as you go from tier 2 to tier 4, your credit risk goes down. So your interest rate also goes down because it's less risk that they have to compensate for.
Sure.
Now, loan to value, LTV.
Mm-hmm.
Are you good on that one?
No.
All right, let's talk about that one too.
Okay.
Loan to
It's been
value.
a while since we've got to talk these terms.
Sure. So 80% loan to value would mean if the value of the property is $1 million, I'm trying to borrow 80% of that value.
Okay.
Be 80% loan to value. But the loan would be for $800,000.
Okay.
The higher it is, like he was talking, the tier 2 loan would be LTV of 80. That's a lot of debt on a deal. You don't have that much margin for error there.
Yeah.
And so you're putting 20% equity in and you're borrowing the rest.
Yeah.
That's a higher risk scenario. And so, you know, same property, if I'm bringing 45% equity to the deal, I'm putting my money in and they're only putting in 55%, the risk is way lower. There's a lot more room for error there. I could be wrong about some things and they're still safe as the lender.
Right.
So that's LTV.
So essentially, if you got a loan to value of 60%, 60% of it is borrowed money.
Yes.
Yeah. Yeah. Okay.
Yep.
So the other 40% would be.
And then the other thing he said was spread.
Mm-hmm.
So Kevin, like you're talking to a 5th grader, explain to us what spread is.
The loans are then getting basically bought by an end account who's looking to get some sort of return on a fixed income, you know, bond-like product. And, you know, for them, their options are, okay, I can put this money into the stock market. I can put this money into cash. I can put this money into a money market account. I can put it into treasuries, or I can try and get more yield, you know, and buy mortgage-backed security. So basically that spread above whatever the treasury is that additional return that they need to compensate them for the risk that they're taking for not buying a treasury. So most of the spreads for, you know, agency loans, Fannie Mae, Freddie Mac, are based on the treasury. So if you're doing a 5-year loan, it's the 5-year treasury plus a spread. 7-year treasury plus a spread. 10-year, same thing. So basically that spread is just what you are looking to get compensated above the, you know, risk-free rate of return, if you will.
As who?
As the end buyer of that bond. So if
okay.
you're like a pension fund, for example, and you want to put, you know, $1 billion this year into mortgage-backed securities, you know, with X weighted average maturity, meaning, you know, it's going to be a 7-year investment. You know, they're going to look to get the max spread possible for that risk because they're not just buying the 10-year treasury, which has no risk, right? Even though it's very low risk, which is why the spread is super tight. You know, they need something to be compensated there.
Mm-hmm.
So like right now, for example, if you buy a 10-year treasury, you're at like a 4.37% return on that 10-year treasury bond. If you're going to get a Fannie Mae 10-year loan, you know, you're going to add another, call it 140 basis points on top of that.
1.4%.
So your interest rate is going to be, say, 5.8 or so,
Okay.
right? But the actual MBS buyer who's buying that mortgage-backed security isn't getting that full 5.8%. They're getting, you know, say 4.4 plus a 50 basis point spread for the mortgage-backed security. And then the remaining 90 basis points is going to Fannie Mae and whoever the servicer is of that bond, who's basically saying, hey, are you paying your mortgage every single month? Send us your year-end financials. They're doing all the work. So it's an interesting business because basically you've got a $10 million bond that's paying X percentage per year, and you've got all these different people who need to get paid
Right.
within that interest rate. You know what I mean?
Yes.
So we could probably dive super deep on this. I'm definitely not the expert, but like high level, that's kind of how it works. And that's one of the things, honestly, that drives the multifamily market is we have Fannie Mae and Freddie Mac, which is like the best debt you can get for commercial real estate. It's non-recourse. You can get various maturities. And we're rate locking a loan next week, and we'll probably be right around like a 5.5% interest rate on it for a like $13 million loan.
Okay, cool. So this is actually a good foundation for us. And I know Bo is itching to prove to me that he understands this.
No, but just no. Think about what he was doing as a 22-year-old.
Oh, yeah.
He'd get these deals coming into his desk.
Right.
And he's looking at things like LTV, debt service coverage ratio. The underwriters who did all the analytics on the deal are basically given, here's what it is. He'd stick it in the right tier. Then he'd look to the end user, like, we're going to package these loans, securitize them, and sell them off as a bond, essentially. And I've got to make these people at the end happy. So how do we price this interest rate so that there's enough of a spread to pay the servicer that he was talking about and to give the yield that the investor on the other side, the pension fund or whatever, is dropping all this money and buying these securitized loans. They want a certain amount of spread, and Fannie Mae has to get money as well. So, like, that's not what I was doing as a 22-year-old.
Yeah, no, me neither.
I mean, that's
I got very lucky because I was working just as like a financial analyst for a few months and was helping out the pricing desk. And basically the guy who they had hired from bond trading division left abruptly, and they had me just literally filling in to answer the phones. We had these, old phone, not old, but these high-tech phones that you'd see in like stock trading movies where you've got 150 lines on it and it's just constantly going off. You're putting people on hold, taking this call. So they literally just needed like a kid to answer the phones and say, hey, Jim will answer in 30 seconds, please hold. So it started just me literally answering the phone, knowing nothing. And then over time, they're like trying to hire somebody. They'd interviewed 5, 6, 7 people. And the whole time I'm like, look over here. And finally they were like, we can't find anybody else. I guess we'll give Kevin the job. So that's how I got the job.
Wow.
nice.
Yeah. Wow. I mean, that's better education than you could get anywhere else, just going in there and doing it.
Oh,
and
man.
seeing it. Goodness.
I mean, starting in the commercial real estate career from that side.
Right.
From the financing side, especially with agency debt and understanding how that works.
Yeah.
Like my whole career, I've been dealing with regional and local banks.
Mm.
You know, like I've never, like the stuff we've bought personally and stuff isn't big enough to go for agency debt.
Mm.
You know, like we're very tertiary. It just wouldn't really fit. And so, man, I can tell you how to go get a bank from a loan, or the other way around.
A loan from a bank.
Loan from a bank. But this is a whole different deal. And for him to have that experience early on was probably pretty unique, I would imagine.
Have you ever tried to get a bone from a lank?
I'm sorry, I didn't get that.
I just took the L and the B and switched it.
So how long were you with Fannie Mae?
Yeah, so I was with Fannie for, started in 2017, left in 2021. So I was there for about 4 years.
Okay.
And basically what I did, it's funny because we were talking about your son earlier, just, going with the kind of more standard route and not necessarily starting on the entrepreneurial path.
Mm-hmm.
It was actually a really good move for me because I didn't, when I graduated college, I had like a negative $50,000 net worth. So I wasn't going to be starting any businesses.
Sure.
So it was good because I could kind of start Rockbridge on the side where, I'm on the metro on my long commute every day and I'm calling brokers and then I'm calling them on the way home, at my lunch break, and I'm getting a paycheck every 2 weeks. It wasn't like I was making a bunch of money, but I was able to save money and build out all the infrastructure to say, okay, once I leave, I'm already kind of rolling. I was there for 4 years, but I would say like probably 6 months in is when I really decided like I want to try to figure out how to eventually, leave and take the more entrepreneurial route.
So you're building like you said, it's 22 years old, right? There for 4 years. So you leave at 26, if my math is correct.
It's pretty good.
But yeah, And so you're listening, you said you're listening to a lot of, on your commute, making phone calls, you're listening to podcasts, you're reading a lot of books. Is it what you were learning from those things that gave you the confidence or made you decide, helped you to decide to start Rockbridge? What was it? Like, what gave you that drive?
Yeah, I think that's a good question. I mean, if you guys know, you guys are doing a podcast. If you listen to enough podcasts, you kind of just get inspired by all these people who are doing amazing things.
Mm-hmm.
So I think that just meeting different people who were living a different life than I was and who were, at the beginning, and also I would say the interest changed over time, where in the beginning it's like, I want to work for myself. I want to build like a life for my family. And I really like doing deals. And, that's changed to, I feel like this is the calling that God has put on my life. And I think we have a real opportunity to make an impact within the multifamily real estate world. And I think that God has put me in a very unique, specific place to do that. And I feel responsibility. So it's kind of changed over time, where at first it was like, I want to make money. I want to do deals. I want to get out of this 800 square foot condo. And then eventually it's like asking the bigger questions of like, what do I really want to do with this business? And like, what am I supposed to do? And I was very lucky to meet a lot of like the right people along the way. And then I guess the last thing I would just say on is like, and you guys probably know this just with different things you've done, like whenever you start something new, you really have no idea what you're doing. And then you kind of get into it and you realize like, wow, this is actually possible. Like I can figure this out. I can start a podcast. I can, whatever. So it's kind of the same thing where it's like you close a couple deals and you start to learn that this is achievable. And then you look at these other people who have done 50 deals and, you realize like, man, I can figure this out if I do it the right way. So I think it was just kind of a combination of those things.
Yeah. Well, tell me about, because we've mentioned multifamily. All right. I'm not familiar with Rockbridge. So why don't you tell us a little bit about like, what is Rockbridge?
Yeah. So basically Rockbridge Investment Group, we buy apartment complexes and built for rent deals, which operate very similarly, but they're kind of different in a few specific target markets that we have identified. That we really like, that we think will do well over the next 10, 20, 30 years. And we bring investors along for the ride. We raise money primarily from high net worth investors who are looking to get exposure to multifamily real estate in those markets that we're in. And we're operators. So we're going out, we're finding deals. We're underwriting them, we're offering on them. And then we're also going out raising money to close those deals, putting the debt together, putting the business plan together, and then we're actually executing the business plan. So we're on site, on our properties on a weekly basis, checking in with our property management teams and actually making things happen on site. So that's kind of who Rockbridge is.
And how do you identify the markets you want to be in? What?
So
That's what I just wrote down. That was my question.
That's a great question. I'd be interested, Bo, how you think about this too. We want to be able to drive to every single property, within a few hours. One of the things we've learned is just like actually being on site, knowing your property manager's name, knowing their kids' names and like their life story actually really helps with property performance. And you get on site and you find all these issues that you never would have known existed looking through a Zoom camera on like a weekly asset management call. So that's part of it, is like we want to be in close proximity to the markets we're in. The other thing is just very simple stuff. So like, job growth, population growth. We want to make sure we're looking in markets that have above average job population growth. We want to have industry diversity. So we don't want to go into a market where you've got a single industry that makes up 25% of the market, because if that industry gets affected, we could have major issues with occupancy, incomes, tenant credit quality. The other thing is just the landlord tenant laws. So, we're looking primarily in states that have favorable landlord laws where if somebody doesn't pay us our rent, we can evict them. And those are really the main factors, I would say. The last thing I would just add is we'll look in any market. We'll look in our general area of, Panhandle of West Virginia, Virginia, North Carolina, South Carolina. But, North Carolina, for example, is an extremely hot market. Especially in the Triangle, and in Charlotte.
And in the
So like,
summer,
yeah, I mean, you're talking 110, 115 degrees,
Yeah.
right?
yeah, that's right.
Oh gosh. But like we've never won a deal in Charlotte. I'm not saying we won't ever, but we've bought a lot of deals in like secondary, tertiary markets where we kind of feel like we can have an upper hand where we're buying deals at a good price. Like we can build the relationships with the sellers. Like one of our best deals we've ever bought, I met the guy at a pizza shop drinking a beer, and he owned this pizza restaurant, which was connected to an apartment building he owned. Turns out he owned like $300 million of real estate, and I got to know him. And 6 months later, he wants to sell a property, and we bought it for a really good price. But those are like, that doesn't necessarily happen in downtown Charlotte or some of these major markets. So going into these secondary, tertiary markets where we can just build relationships with people and over 5 years, get into the position to buy a deal when they're ready to sell, that's really resulted in a lot of value for us. We've got like a ton of really cool stories of deals we've bought, that I could share that are just kind of speak to that.
Every time I drink a beer at a pizza shop, I'm always talking to the bartender, seeing how many of these I get for free just because I'm doing the open mic that night.
Oh, that's your payment.
What's your
right?
average free beer per open night? Is there like a standard?
Well, at open mic, none. No, you're paying for your own beers. But on a lot of these other shows that you get on that aren't quite open mics, but aren't quite like you're getting paid, you'd get around two beers, right?
That's like just enough. If you have too many, like you might be saying some crazy stuff up there.
That's exactly right. There is a fine line. There's a very fine line between loose and too much. It's true. It's very true.
I'm sure.
Yeah.
Sounds like you perfected it.
Yeah. Yeah, the hard way.
By the way, we pick our markets the same way. And with Hearthstone, what we're doing is we're really picking our sponsors in the markets they're in. And so just like he was talking about, they want to be able to drive and be on site.
Right.
That makes a ton of sense. The geography issue that he's talking about is very real. Well, for us as a fund of funds, like we want our sponsors to be able to drive on site. We don't have to.
Right.
We're not the ones executing the business plan like he was sharing. And so, that means something to us. But the other things that we're talking about that he was mentioning are exactly the things that we look for when we're looking at a deal that one of our potential sponsors is sharing with us. Like when we look at do the market analysis, we're looking at job growth is the main thing. Job growth is the main thing. Population growth follows job growth naturally, so you don't generally have one without the other, unless it's very, very touristy. Mm-hmm. So some parts of Florida, you'll see population growth because people are retiring there, and you won't really have the job growth, and so the economic impact of those people being there isn't quite as powerful as if the jobs were there. Otherwise, that economic diversity piece, though, is a big deal. The more tertiary a market is, the more it can really rely heavily on one or two markets, which make it riskier. Yeah. And if it's riskier, you're going to want to pay a higher cap rate, lower price. And so all that factors in.
Right. Now, Kevin, you obviously you're a man of faith, and a lot like our dad, when he was, and Bo too, a lot of their faith informed how they ran their business. However, it wasn't a business that was a ministry as such. That makes sense, right?
Yeah, you're not your business is not explicitly a ministry, but you may be doing ministry within your business. Is that what you're saying?
Yes. And so I was wondering too, because what I am familiar with was the first sponsors that you all
launch
capital, and there's very much had a ministry piece to it. Sure. Right. And within that, it was one that did good. So that, I guess that's my question. Does Rockbridge have a bent where it does work as a ministry, or
let me rephrase.
Yeah. Thanks.
Kevin, if you've watched many of our episodes, you will hear me rephrase sometimes.
Yes.
But how does Rockbridge do good?
Yeah.
How do you guys make a positive impact from a faith-driven perspective in what you do, in housing people?
The quick answer is we partner with two different groups where we are giving up a unit for free on our properties to a couple who's then running all of our community events. They're doing new move-in check-ins. They're doing like a 90-day post-move-in check-in, and they're building community on site. Has multiple components. One, apartment communities are extremely lonely. I want to say the stat is something like less than 2% of people in apartment communities are connected to a local church. So people are dying to know people. Like, we've all heard that we have a loneliness epidemic in the country, and I feel like in apartment communities it's probably only exacerbated. So that's one aspect of it, is like they're just building community. They're making friendships, making connections. And then two is like they're actually caring for people. So if you're just out there, but you're not actually caring for people's needs, it's not as impactful. So because we have, and it's tough too, because if you have property managers on site and they're knocking on your door because you're late for rent, and then they're turning around saying, hey, how can I help you with your life circumstances? It's a tough balance. So actually freeing up our property managers to really focus on like running the business, operations, not that they can't be involved in that, is really helpful to have that kind of team on site to act as a tool and an assistant to the managers. And a lot of our managers too benefit from this because we work with two different companies. One's called Apartment Life. One is called Way Forward, which we're actually just launching our first community with them in a couple months. Their goal is to just share the gospel with anybody they come in touch with, whether it's the maintenance supervisor, the property manager, somebody down the hall, a vendor on site. So that's kind of the explicit way that we do it, very simply. But the other thing I would just add to that is I think in any business, like you guys probably would agree with this and have experience with this too. Like you're meeting with so many people in this business, like on a daily basis, we're talking to investors, lenders, vendors, property managers, tenants. I'm probably missing a million other things.
Sure.
And it's an opportunity because a lot of the owners come into a property and they want you to like kiss the ring, show how important you are. But like we show up on site and we always are trying to take like the service mentality, and not to pat ourselves on the back too hard, but like our managers love working with us because they don't feel like they work for us. They really feel like they're on our team.
It's huge.
And they all know we're believers because we have Apartment Life on our communities. We've prayed with tons of managers. So like, I think whether or not you have an explicit ministry strategy, like just being a believer in the business and interacting with people, I think is extremely powerful.
This is fascinating. So there, in all the apartments that you have, or multifamily, you have a couple that lives in a unit that is solely there to be missionaries, as it were.
Yeah.
Is that what, to free up the property manager?
Yes.
To focus on operations.
Yeah. But think of it like there's a real business case for this.
Right.
These people are there to make friends and love on people.
Yeah.
And share Jesus with people when they get the opportunity.
Sure.
Okay. Even if they're just loving on people and trying to build community. People that are in community don't move as often. And one of the largest expenses in multifamily is turnover.
Right.
And average is something like, somewhere close to 50% a year turnover in apartment communities. But if there's actually community there, and I'd be interested to see what your all's turnover average is, but that just natural annual turnover goes way down. And so you don't have these handful of days, even if you got a waiting list, you got a handful of days of vacancy sprinkled in all these units all throughout the year. That adds up.
Right.
So if you can build community, that drops directly to the bottom line.
Right.
And increases your NOI, which increases your value, which makes everybody happy. And it's because you're being good to people.
Right.
So, yeah, that's kind of the business case for it.
Rockbridge is such a perfect fit for Hearthstone. Like, My goodness. Is this official yet, or are y'all still talking?
I think it's official right now. I'll send you the wire instruction
Timmy
right
says,
after
yeah.
the call.
We haven't pulled the trigger on a deal yet, but we've been looking at a couple of their deals, and
Oh my goodness, this is
like,
perfect, man.
yeah, I mean, like, but these are the kind of operators that we're
Right,
absolutely
yeah.
looking for. Yeah. But like, how does
I'll
that
say-
play out? Like, how would you characterize or answer Timmy's question?
Yeah, so I mean, it's really cool because basically you can tailor it for every property differently. So we just bought a property that's like a mile from the beach, right? So we're going to be bringing in a couple, and that property doesn't have a fitness center, but this couple will be doing. They have a number of tasks that they'll be doing on like a weekly, monthly basis. But on a weekly basis, two things they'll be doing is one, they'll be having a Bible study in their unit every single week. And then two, they're going to basically lead a fitness day in the mornings where they're going to walk to the beach, and then they're going to do a walk on the beach. And then they'll kind of finish with like a word, right? So certain properties, you know, you're going to do different things. Like I know some apartment life communities, for example, that are in like Denver, right? So they're going to coordinate hikes and those sorts of things. Other properties, you know, you may have like an awesome playground with a pavilion and a grilling area. So they'll do Taco Tuesday or Wind Down Wednesday or whatever it may be. But it's really just like throwing the community events, using whatever kind of amenities and assets they have at the property itself, and then kind of tailoring those events based on the demographic of the property. You've got more families, you're going to do a certain type of event. You have people who are more retirees, you know, you're going to tailor it that way. So yeah, it's interesting. And I'll say we're still learning how to do this well. I met a guy who is, he has bought, I want to say 20,000 units over 47 years. Average IRR is 28%, all institutional equity, very high quality assets. On average, I want to say he said that he has 5 of these ministry couples at each property.
Wow.
5. And they do, one of the things that he does on all of his properties is every 6 months, he has local mechanics come out and service all the single mothers' cars.
Wow.
Because if you're a single mom, like going to the auto shop, you know, with 3 kids is like impossible.
On the weekend or at night when you're not at work. I mean, everything about that's hard.
Right.
Exactly. So like that gets back to like, how can we be creative to actually serve people's needs? And the results are very clear. I mean, the guy has a 28% audited IRR over 47 years. And also like that kind of ties into it too, is like he takes the mentality of like our standard is like almost perfection in terms of operations, to where he literally has his maintenance supervisors go out and measure how much trash is in the dumpsters every single week. And if they aren't hitting a certain level of trash in the dumpster, he dials back the pickups, which may save him $1,000 a year.
Wow.
Right.
Yeah.
But that's the level of detail that he goes to. So like, just again, going back to like having met some of the right people at the right time, you know, just a conversation that I had with him, he gave me 20 different ideas about, hey, you know, you think you're doing a good job with this apartment life stuff, and you know, you haven't even scratched the surface.
Wow.
So
And
there's a lot you can do.
that's got to be exciting when you hear that. For someone like you, that's got to be exciting to hear how much more, like, and just inspiring, or to get the creative juices flowing of like, I didn't even think about this area here of measuring the trash, you know, for example.
Yeah, that same guy, his ministry teams have baptized like dozens and dozens of people in their community pools.
Wow.
So that's, I think, one of the cool things about this business is like, you know, you have to be excellent regardless of if you have a ministry plan or not, and if you're a Christian or not. So like, that's just a given. But assuming you are excellent and your standards are high and you're doing everything you can to make it a successful investment, like you've got thousands of tenants on site who are counting on you to provide a good product. And like, how many news stories have we seen? And I've been associated, unfortunately, with it, with people who have done a terrible job on site, and the people who live at your properties are getting affected. Like,
yeah,
that's just not right. Like,
right.
One, you're not going to make money. Your investors aren't going to make money. your residents are going to be living in a terrible circumstance. So it's both like an amazing opportunity, but also a huge responsibility.
Yeah.
And it really goes back to also just how like kind of LTV and debt service coverage ratio. If you're operating at a 1.0 debt cover and a 90 LTV loan, are you going to have any money to invest in giving up a unit for free? Like, no. So the times we've really gotten into trouble and where I think we're not caring for our tenants' needs is when we underwrote a deal incorrectly and we need to tighten up on, oh, we're not going to be able to do a community event or whatever. So like more and more, I just think we're learning it all ties together. Like one doesn't work with the other. You know what I mean?
Right.
So how do things change in a build to rent community versus an apartment community? And I'm really interested in this question. And because one, Timmy, are you familiar with the build to rent?
Well,
it's kind of a new thing, but it's whole neighborhoods that are built to rent. They're single family homes basically, or some kind of, they're not apartment communities, right?
Okay.
So what are the differences there, and how can you still operate well? What are the advantages of build to rent versus just a traditional multifamily community, and how can you still love on people and build community when they're not quite as connected on the property?
So I would say that it's no different, to be honest with you. The built for rent communities, there's some real advantages. So just a couple examples. One, the built for rent communities we're buying, each home is individually parceled, right? So like from a financial perspective, you have flexibility on the back end where if you want to chop it up and sell these all one-off to retail home buyers, if there's a massive premium on that, you can do that. You'll also get better financing because you can, instead of doing a commercial appraisal, you could say, I want to do a residential appraisal. Well, all of a sudden you're appraising 80,000 per unit higher. It's a lot easier to show a better LTV, with that kind of lens. You also, on built for rent properties, what we've experienced is our turnover rate is about 30% lower. So like our average turnover on our apartment deals are around 40%. For our built for rent communities, they're typically between 20 and 25%.
Wow.
So, 30 to 50% lower. Like I remember last fall, we had a month at one of our properties, it's 100 units, where we had 8 renewals coming up in November, which is like a terrible month to have a bunch of turnover, and 7 out of the 8 renewed. So like built for rent communities, because it's more like a home, you're getting larger units, you're getting, in most of our case, our deals that we do have private fenced in backyards, patio, their own dedicated 1 or 2 driveway spots, 1 or 2 garage spots. It's almost like you're living in a home, but you are renting.
Yeah.
So you're getting kind of the step up from like an apartment deal where you're in like an 800 unit box with somebody below you and above you. We've got tons of those, but you're going from that to, hey, this is somewhere where I could grow with my family and live here for 5 years. And a lot of people who can't afford to buy a house or maybe want to maintain the flexibility while they're looking for a house, this is like a really good kind of step up from an apartment complex, but not quite owning your own home. So those are some of the differences. In terms of building community, it's no different. I mean, you have to be careful with like just understanding how the site is laid out, and you may want to add amenities, but sometimes built for rent deals you're looking at, they were set up with no space for amenities. So it's going to be a different picture there. But for example, the deal we just closed on, it's 99 units. The home builder who we're buying it from did not want to add any amenities because that costs money. So we're adding a playground, a pavilion, grilling area, and then also building a nice maintenance shop. So you just have to be a little bit creative with it, but it operates exactly like an apartment complex. I'm just trying to think of like operationally what's different. I mean, it's small nuances stuff like trash. How are you doing trash?
Yep.
Security cameras. Some of the fees are different. Like we'll do what's called a community bundle instead of like, for other income, which will encompass trash, pest control, security package, smart home package, stuff like that. But I think it's honestly just a better version of apartment complex.
Yeah. But it's like with build to rent, you got 99 units and a pool ain't one. Is that right? Not many amenities
Your
earlier.
jokes, but these are just, you're killing me. Bo doesn't even laugh at you anymore, does he?
I
Sometimes he's a
laugh
little
when I
slow.
understand them.
So-
That one I didn't get.
Yeah, sometimes, yeah.
I
Oh,
don't
that's
fake
good.
laugh at him.
No, he
for sure.
doesn't. No, he doesn't. Going back a second. So I think Bo was gonna ask this question, and he might even rephrase mine. With teaming up with Apartment Life and Wayform, have you seen a difference in the turnover rate compared to the average with that?
So the actual stats are not as clear as I would like it to be.
Okay.
They have put out data that across, because they have hundreds of thousands of units within Apartment Life. So the data from Apartment Life, and I'm on their regional board for the Mid-Atlantic, so like I see it at a wider scale, is I want to say like 10% lower on average, which is massive.
Yeah.
So if you have an Apartment Life team on your community, on average, the turnover rate I want to say is about 10% less, which is huge. 500 unit apartment complex, that's 50 units a year. That's massive. On our portfolio, we don't have Apartment Life on every single deal. We're trying to do that, but actually recruiting the right team takes some time. But it's honestly not as clear. It's pretty muddy, but we have tons of anecdotal stories of so-and-so is going to move out. We send the Apartment Life team out there and they ended up getting them to renew.
Yeah.
Or they found out why they were moving out and they wouldn't tell the property manager, and we were able to figure out a solution.
I see.
So on our properties, I can't tell you like, hey, 4%, 10%, but I know that Apartment Life has put out a ton of research across their hundreds of thousands of units, and I want to say it's around 10% less turnover on site, which is huge.
Yeah.
Well, I can tell you with a portfolio size, you mentioned that your multifamily turnover rate's around 40%. That's pretty good. So it seems to me that what you're doing is making a difference, whether you've got a lot of clarity on how much that is or not. But 40% is pretty good.
Yeah.
Yeah. One thought on that, though, one of the things that we really started doing early on is we don't love buying deals that are that have a lot of one bedrooms. For that reason, the one bedroom properties, they have way higher turnover. So we have a lot of deals that have like 2, 3, 4 bedrooms, and those. So I think that's probably part of it. Is your
that makes
turnover
sense.
rate is a lot lower on that.
Mm-hmm.
I just saw Alice pop in there for a second. Hey, Alice. It's probably an accident. I just popped in. I heard music for a second.
Yeah, I heard that music. I was thinking that was on my side for a second.
Yeah,
No, man, that's coming
Alice.
straight to you from the Philippines.
Yeah, baby. Yeah, baby.
Oh wow.
When you said Salisbury earlier, is that Maryland?
Yes.
So you know who lives in Salisbury, Maryland?
Yeah. I almost had the same question when he brought up Salisbury.
Brent and Amy Miller.
That's right.
Do you know the Millers, the SVN folks there? Brent and Amy?
My friend works at their SVN branch, who I led Young Life with, but I do not know them.
Oh, yeah.
Who's your friend?
His name's Chris Messick.
I know him.
Do you?
Yeah.
Chris was like a Young Life kid when I was first a Young Life leader at Salisbury, and then he became a leader as well. And he was like a surfer bro, and now he's a commercial real estate guy. So that's funny.
Wow.
Hold on, I'm going to pull him up and make sure I...
He's a young guy.
Okay, he is not who I'm thinking of.
Oh, okay. Well, shout out to Chris anyway.
Yeah, what's up, Chris?
Yeah.
Yeah,
Shout out.
his Brent and Amy were just on the podcast a couple months ago.
Yeah.
But I've known them for years. I went and
Awesome.
visited. I stayed in their home.
They're great.
It's they're a power couple up there, and they dominate that market. But
I love the Eastern Shore. That's like, actually, it's funny. I just looked at my email inbox. I had a meeting with Brent and Chris in 2022. So, but yeah, Eastern Shore is a great spot. I don't know if you guys have been out there, but amazing hunting, fishing. You can surf out there. It's God's country out there.
Amazing.
how? Tell me about your plans for the future with Rockbridge. Like I know you're in for a long time. Is that your next?
Yeah.
Right.
What's next?
But like, What are you trying to do in 2025? What are you trying to get to? Like, are there some milestones? I want our listeners to be able to hear you and think, not a fit for me, or I need to get in touch with him right away, kind of thing. This episode is sponsored in part by Site to Do Business, the ultimate commercial real estate data analysis and mapping tool. Whether you're a seasoned professional or just starting out, Site to Do Business provides the data and insights you need to make informed decisions and close deals faster. Frankly, it's the tool that I use the most in my business. Access comprehensive market analysis, demographic data, and powerful mapping tools like ArcGIS, Placer AI, and flood maps all in one place. Identify the best locations for your clients, analyze market trends, and present your findings with confidence. Don't miss out on this game-changing platform. Visit stdb.com today and see how it can optimize your business. And now back to the show.
Basically, 2025 has been a really good year. We've acquired 3 deals. We have nothing under contract right now. And we've kind of just made the decision of, we're still going to underwrite tons of deals, but we are actively trying to not do any more deals this year because we want to just make sure our existing portfolio is just operating on all cylinders. And it's just good to get a little breathing room after having been under contract on a bunch of stuff for a while. So I'm actually really excited to just focus on operations. Like I'm actively talking to new investors, and like I love copying and pasting what our current occupancy is on all of our built for ed deals because they're just crushing it right now. And it's like I want to make sure we can keep doing that. And like one of the things that we're really working on is like as AI becomes more prevalent, I think one of the mistakes that a lot of operators make is they have insane overhead on the personal side and on the business side. And then they all of a sudden have to do deals to keep the lights on, and they end up doing bad deals. Because like last year we underwrote 420 deals and we bought 4. So like you have to look at so many to get good ones. If you're looking at 50 deals and you're buying 10, you're probably overpaying. So one of the things we're really focusing on is how do we keep our team as small as possible, but become like way more efficient so that we don't have to go do a bunch of deals.
Yeah.
So the rest of this year is really like focusing on operations, getting things as tight as possible, improving our systems. We have a lot of things that we know we need to improve. And just honestly setting ourselves up to where next year, if we want to do 2 deals, that's great. But we don't, God has different plans than I do, obviously, and we'll see what he has planned. But like, I don't think that we're going to ever try and be like the next Blackstone. Like, I really think that doing like 2 to 4 very high quality deals, figuring out how to operate them extremely well and just build a really good portfolio, I think that's who we're going to be. And that's kind of looking ahead, our goal. Like keep buying great assets in great markets where we can actually have a legit, ministry plan and still do extremely well for our investors and keep the smallest team possible to manage those assets. So that's kind of what we've been thinking about internally. And with that comes, okay, well, what kind of assets are we going to buy? And that's a different conversation. But I think, our target markets, like, we're really bullish on them. We want to keep looking at deals there. We want to buy the best built for rent and multifamily deals within those markets, with business plans that we know we can execute on. And it's just, kind of finding that needle in the haystack.
I was talking to a guy in Ohio. He has this phrase, Kevin, I think you'll like this. They're digging for basis all the time. Man, he said that to me one time, and I was like, oh, that is exactly what you're doing when you're looking at 420 deals, I think you said, in a year, and you picked 4. Like, just sourcing 420 potential deals is hard.
Yeah.
It's a lot of work. Like, and that whole time you're digging for basis, you're making sure you find the right deal, buy it at the right price in a market that's growing so that you can stack the deck in every way. Because regardless of what we do, everything can go south.
Yeah.
And so, man, you want to do all your homework on the front end so that you give yourself the best opportunity to hopefully exceed all your projections.
Right.
Which is totally possible, but protect yourself from the downside at the same time.
Because I have my CFA, my business partner who runs CFO, he's got his CFA. So we like to overly financially engineer stuff. And we had this phrase last year, and we just kept saying, don't be smart. Like, don't be smart. Because once you try to be, you try to over financially engineer stuff and do this strategy and that strategy, that's when everything has to work perfectly and you make mistakes. And it's just funny because it's like the longer we're in the business, the more we realize the old guys know what they're talking about. Like, buy in really good locations and buy at a good price, and the rest kind of takes care of itself. And the mistakes we've made is like, not buying in a great location or paying too much. And it just makes everything more difficult. So I could not agree with you more on that, Bo.
Yeah. KISS. Keep it simple, stupid.
That's exactly right.
Exactly.
Yeah, that's right. With your track record now of being 30 years old, and with hearing your story here, first of all, it's very impressive. You're very well spoken and you look great on camera. So I don't know if you've got if you're going to go a Justin Ryder route, or if you had any thoughts on that as far as like making content or doing things like that. You'd be really great at that for what it's worth. But what I wanted to ask you was that I'm sure anybody listening here that are on the younger side in their 20s, what with everything that you consumed during that time on that commute and during that period while you were planning and building what is now Rockbridge, what would you recommend to your 22-year-old self to read? Like, what would be the number one besides Commercially Speaking or the Bible? What would it be?
Yeah, this podcast is definitely number one. That's a given. So
You don't have to say that just because you're on it. Yeah.
It's funny because when I was first getting started, I just listened to everything. Like I would have 12 answers for you.
Yeah.
So like all the podcasts that you guys know, from Bigger Pockets to whatever else, I was just like an absolute just fiend. Like if I was driving, if I was working out, if I was walking to the bathroom, like whatever it was, like I was listening to a podcast on 2x speed, and I didn't retain all of it, but like it kind of gets in you.
Yeah.
So like I would say, like looking back when I was 22, that'd be my answer. Like I read a ton of books. I think one just quick one that sticks out to me, Set for Life by Scott Trench, was a really good one, and it's just about like kind of setting yourself up financially with very simple ways. I mean, I could list like 100 books for you. But I think just like it's shifted over time, where before I really listened to like mostly real estate podcasts. And now I don't listen really to any real estate podcast.
Yeah.
We read a lot of research. But I've shifted more now to, business podcasts. I like John Piper. He has a daily podcast. He's a preacher, and he's been a preacher for like 50 years. So every single day so he's good. So I listen to like sermons. I listen to like business podcasts, politics, Joe Rogan, but I don't really listen to many real estate podcasts anymore, to be honest with you.
Yeah. Yeah. No, fair enough. What I'm hearing you say is like, you would say being obsessed with consuming and learning, and getting as much information as possible would be, what you would say to your younger self. Yeah.
The thing I'd add to that too is, I think everybody, like when you're 22 years old, everybody wants to be like, well, I'm only 22 years old and how am I going to do anything? But like, I think being 22, 23, 24, trying to grow a business is like the biggest advantage ever, because all the older guys who have more money than they know what to do with, they want to help you.
Yeah.
So I have been like, when I was just getting started, I had more breakfast, lunches, and dinners with guys that I had no business ever having breakfast with.
Wow.
And that was where I got a ton of wisdom, like very like practical stuff. Like, how do you set up an operating agreement to make sure somebody's not going to steal your equity? Like when you're talking to potential institutional equity, like you have to ask them, where's the money coming from?
Yeah. So,
you know what I mean? Like some of these things. So I think that is also something I would recommend, is just trying to get into touch with those people.
Am I hearing you say that at 22, it's a lot easier for people to say yes to a breakfast because you're young and hungry?
I think people are just so much more willing to pour into people than you think.
Yeah.
Than like most people think. And I think, like when I was first starting to call brokers and stuff, just like starting off the conversation with like, look, I haven't bought any deals. I don't know it much. I'm not going to waste your time. And just starting from a very humble position and being honest rather than faking it till you make it actually paid off better for me because people were just like, all right, like he's not pulling my leg. He's not wasting my time.
Yep.
And then the other thing too is, so it's one, it's the older guys, but two, if you're 22, 23 and you're trying to buy real estate and there's other brokers who are your same age, like they want to go golfing with you. One, because you're going to have more fun with somebody your age, but also if they're looking out 20, 30 years, they know like, hey, this is the guy I want to know. So I think, and the other thing too is like mentally, if you're starting a business when you're like 50 years old, I feel like you almost think you have to make up for lost time. Whereas when you're like 22, 23, if you get one deal done in 3 years, you feel like you're the biggest hero on the planet.
Yeah.
So
true.
it's very encouraging because you're like, man, like you don't need to do that much to like kind of keep the positive mojo going.
Sure. That's a good point.
That's interesting. I'm approaching 50, and Hearthstone was our newest business. It's been around not quite 2 years left.
Yeah.
I don't feel like we have to make it. I don't feel like I'm making up for lost time, but I have friends my age who feel like they're behind. Mainly because they're comparing themselves to other people.
Right.
And they're saying, hey, this guy we graduated with, he's way over there, and this guy's way over there, and we're just back here. And the comparison is the issue.
Yeah.
If they would just relax and just step into who they are and the situation they're in and make the best of it, they'd be much better off.
Right.
But you're right, man. I'll tell you, though, Kevin, when I started in the business, I got out of the Marine Corps, I was 27. I started working with my dad. And it was a couple years before I had the confidence to do anything. And when I say do anything, like it was that little voice in the back of my head that said, I don't know enough. I'm too young. Who's going to want to work with me if they could work with my dad,
Yeah.
And it held me back. And I'm encouraged to hear that doesn't sound like you allowed your age to hold you back. Instead, you used it more like a superpower. You're hungry and you're young and you've got more time when you're 22 than when you can really dedicate a lot of time.
And I think too, you saying, hey, I've not done any deals, I haven't bought anything, I'm not going to waste your time. That there answers one of the top questions, which is how do I get a mentor? I think you answered it in that right there. Be humble and make the call.
And tell the truth.
That's right.
I can't stand that fake it till you make it stuff.
Yeah. Yeah. There's nuance to it, but no, I agree with you as well. I think,
And I'll be honest, Timmy, like, so the first deal that I got under contract, I had underwritten 112 deals. It was the 113th deal that I looked at and offered on.
Wow.
And, every single time I called a broker for the first like 2 years, like I would have to sit there for 5 minutes before calling the broker because I'm like, they're going to know I know nothing. Like I was very nervous making those phone calls. And it's funny, like I was actually just talking about this the other day. I remember when I first started working at Fannie Mae, I would spell check an email 50 times before I hit send because I was so nervous I was going to screw something up.
Yeah.
So I do think that there is that natural progression and the only way to get over it is reps.
Yeah.
Like you got to try to maintain your reputation in the meantime by not making too many big mistakes. But you just have to get reps. And I get into these meetings with like some institutional equity people or even like if I'm on a lender call, and we're talking about some legal concept that I have no clue about. And I've slowly become more comfortable with just saying, I have no idea.
Yeah.
But it's obviously it's a lot easier to just act like you don't know and deflect. So I still struggle with that.
Yeah.
But I think more and more I'm learning, like, it's almost like the less that you know, it's almost better because then people rush in to give you the solution.
That's right. Yep. Kevin, that's huge. I mean, you just sharing that, just your inner monologue or, it took about 5 minutes of talking yourself into actually making that call or repping yourself up. That's so valuable to hear. That's the stuff nobody sees. They see, well-spoken 30-year-old with an incredible track record. Oh, it must have been easy for him. But no, I mean, thanks for sharing that. That's huge.
When you're somewhat of an unknown, you've actually got a much wider apron to make mistakes. Because I can almost promise you that, like, Kevin, those first 100 calls you made to brokers, if you didn't talk to them for 6 months and you called them back, they're probably not remembering you. You could have absolutely fallen on your face, called that same guy back 6 months, and he might not have remembered. Before you're established, there's a lot of freedom to fail there at the beginning.
So true.
At the beginning.
So true. That's the advice I gave to young actors
That's a
all the
great
time
point.
when you're going in and talking to a casting director or going into audition and you just do awful. And it was your first time to go and see that casting director and you're like, oh, this is going to be, this is going to be a great opportunity to show them. And then you just bomb and you walk out and you're like, I'm never working there again. It's like, no, they forget about you. Unless you're an asshole, they completely forget about that. And, 6 months later you go in and you crush an audition or they have you back. Anyway, just a little comparison in my world.
Yeah.
It is funny, like we're how self-centered we are as people. Like we forget that nobody's going to remember what color shirt you wore yesterday. Like you could wear the same thing 6 days in a row and most people won't even notice. You know what I mean?
I do that sometimes.
I rotate through the same 3 outfits every week. So I'm with you.
Yeah.
I am basically I've got a shirt for every day of the week kind of guy.
Yeah.
Yeah, for
Right.
sure.
I've got too many shirts, but just wear the same 3.
If I wear something 2 days in a row, then my daughter will notice. And
Yes.
she will tell me.
Yeah. That's true. Yeah.
Now, do you have kids?
I do. I was actually going to be curious to ask you guys about that. But yes, I have 2 kids. I have a 2.5-year-old boy named Caleb, and then I got a 6-month-old daughter named Hannah.
Oh, 6. Hey, congrats.
Yeah, that's
Thank you.
and yours.
Yeah. I've got a 7-year-old named Una.
7.
Yeah, she's 7.5. She's going to be so pissed if she hears me say that. She's 7.5 daughter named Una and a 3.5-year-old named Birdie. Birdie May.
Birdie May.
You've got some, man, you are ballsy with the names. That's like, I love it.
Yeah, Una Nova and Birdie May. My wife is from Ireland, so those.
Okay.
Yeah, so that gives us a little bit more leeway.
I love it.
Mhm.
I'm over here just with like the classic boring biblical names. I need to step my game up is what it sounds like.
Right, Caleb and Hannah. Those are great names, though. Those are great names. Yeah.
My oldest is named after there's a lot of Williams in my family. So my oldest is 22. He'll be 23 in a couple months. His name's Will. He's a William like the rest of us. My middle son, Ben, is 19. He just graduated high school, works in the lumber department at Home Depot, and just applied to the fire department.
Oh, really?
Awesome.
Yeah.
That's perfect.
Oh, yeah.
Right?
He'd be great.
Oh, my goodness. He'd be an incredible firefighter.
And he still may enlist in the Marine Corps.
Yeah.
We'll see. And
Oh,
then
nice.
my youngest is 16. She just turned 16, driving a little bit.
Maddie.
And she'll be a junior in high school. Yeah,
It's
Maddie.
great basketball player.
Yeah,
Really inspired my daughter to be a killer basketball player. Yeah.
Love that.
Yeah.
Bo, I have a question for you.
Yes.
So my kids are very young still, so I have a bunch of time to figure this out. But what were like, you're an entrepreneur, so your kids have seen you do different things. What was your thought process like as you're raising them, in terms of, hey, do I want to eventually involve them in the business? How do I want to teach them? How do I make sure, they have a great work ethic? Like, what were some of the things that you did right? Now that your kids are getting older, and I'm sure there's a bunch that you did wrong too, but
I wanted to teach my kids how to think. The most annoying thing about being a parent to me is that I can't make decisions for them. Now, as they're growing up, especially when the kids are your age, like, you can control their environment. You can teach them manners and all that stuff, which you absolutely should. But you can't make the most important decisions for them, which is very annoying. So I want them to be able to learn how to think. Like, like critically. And so anything that happens in life, I was always looking for opportunities to have a conversation about what's going on in my mind, how I'm processing through information, how that person did something like that. So I was always looking for kind of like teaching moments where we could have those conversations. And I've got a list of things I wanted to teach my kids before they left the house. And I don't know where I got that idea. It certainly didn't come up with it on my own, but I had it way too late in life, like in their life cycle in my house. Like I wish I had that list when they were 2.5 and 6 months old, or however. So there's that idea in the back of my head. I want them to be able to think well when they leave the house. But as far as the business goes, I never felt any kind of pressure from our father to be in the business.
Right.
Now, I am in the business that was his, and that was our grandfather's before. Like, I'm in it. But I never felt pressured to do it. And our dad never really brought things home. So what I've tried to do...
Work-wise. He left work at work. I didn't know what he did. That's one of the reasons I was excited about doing this with Bo, was just to learn to learn. He didn't talk about it, much to us, but yeah, he really separated that. Yeah, so.
Now, I talk about it more with my kids. But I've tried to be a student of my kids and learn who they are, learn about their personalities, and just pay a whole lot of attention to how they're growing up, who God has made them into. So the last thing I want to do is try to make them like me if God made them like something else, like square peg and round holes, bad idea. And so I've tried to be a student of my kids so that I can help them excel in the lane that they need to be in. And so I viewed myself as an assist, as a kind of a guide to help them figure out what their lane is. And so, we were talking about right before we hit record, my oldest son, he just graduated high school. He looked at going into commercial real estate. Now, my deal was, you're not starting with me. I want you to go somewhere else, like with maybe Matt Stone, Justin Ryder in Lexington. There's a guy he shadowed in Louisville. I stuck him with a buddy of mine when we were in Austin, Texas. He came down there and shadowed one of my buddies down there for a day. And if you wanted to get into commercial real estate, it's kind of like pick your town. Where do you want to live? Let's try to get you connected there and do it for a couple of years, see if you like it. And then, man, you want to come back and work with me? I'd love that, But at least at first, he's got a job with Enterprise. So he's in their management program. That's a great opportunity as well. It's more secure than commercial real estate. So, he's trying to figure out, should I be an entrepreneur or should I not? And he needs to figure that out. So I just want to help him figure that out. With my middle son, he's the one that, he graduated high school with an associate's degree, but his plan was never to go to college. Like, he's looking at the trades. He loves to work. He loves being around people. He loves to work. He didn't want to, wait 4 years to do it. He just wanted to get right into it. He loves to serve. So the idea of being a fireman or maybe going into the Marine Corps, I'm just trying to help him understand his options. But my daughter, she's probably the most entrepreneurial of all of them, and she's starting a photography business right now. And so I'm helping her with the website and the logo and doing some of that stuff. And, how do we finance? I pitched her a deal. Like, I'd buy her the lens she wanted for equity in the company. She's like, no, I'll wait. I'll save that.
Yeah.
And I was like, that's exactly the right decision.
Yeah.
If you're starting something that could be really good, the last thing you want to do is give up equity.
Yeah.
So I'm just looking for opportunities to teach the kids and to notice what they're interested in.
Yeah.
Like the last syndication we did, that I did personally, before we started Hearthstone and kind of transitioned into the fun-to-fun things. The last one, I was like, hey, look, if you guys will allow me to teach you how I did this deal, I'll give you a little piece of the GP with me. So their buy-in was allowing me to teach them how I put the deal together and how a syndication works. And like, I wanted them to understand it, and just kind of gauge how interested they might be in it, if it sparks something in them. And it didn't really seem to interest. I mean, they were all in. They all wanted the equity, but none of them went through that and thought, oh man, I want to do that for the rest of my life.
Yeah.
But maybe later,
Right. Yeah.
And I want to help them think. I want them to see options. I want to help them land right in the sweet spot of who God's created them to be. And that's not up to me, but as their dad, I've got a bird's eye view on maybe where that could go. And I just want to help them get there. And you're right. I've made a ton of mistakes.
Yeah.
Yep.
No, that's cool. I feel like there's a lot of people who probably go their whole life and they don't actually end up doing the thing that they were created to do.
Mm-hmm.
Yeah.
Because it's probably just a lot of people who don't even have time to think about it.
Sure.
So as a parent, to kind of help direct, them being able to figure that out. I haven't heard it said that way, but that's awesome.
I will say something else. I read a book. I don't know if we talked about this on the podcast. Maybe we have. The book's called Full Time. I forget who wrote it. We'll figure it out and put it in the show notes or something. Yeah. Full Time. It's all about, and it's a fund manager who wrote this book, but he's a believer, and the book's all about the value of work. Like, work in and of itself is good, and it's valuable.
David L. Bonson.
Yes.
Bonson. Yeah.
David Bonson.
Bonson.
Yep. And he says, starting with the World War II generation, that was the first generation that viewed work as something we have to do so that later we don't have to do it. There was never that mentality of, I'm going to work for a certain amount of years so that I can retire and not work.
Right.
So work is something that is not, in that mentality, work is not good. It's not right in and of itself. And, man, we grew up with a dad who believed in the value of work in and of itself. And so even if you don't find your thing, there's value in getting up, being of service to others, earning a paycheck, and being able to provide at least for yourself and maybe for your family.
Yep.
Like, that is valuable and it's good, even if you don't like what you're doing. Being of service to somebody else is valuable, and that's really what work is.
Yeah. I've also seen a pattern, too, with a lot of guests that we've had on where their kids have joined the business or work for them in some way, shape, or form. And one common thing that I've heard a lot is like, we did not push them to do this, but they learned a lot of it from just watching us, watching our work ethic and watching what we're doing. So that's huge. Your kids are always watching. And then one other thing I wanted to say, because I was, Maddie, Bo's daughter, will watch our kids sometimes, and I will give her the ride home. And I remember saying you texted her, she was texting you, and she's a teenage girl, and teenage girls are supposed to go through a period of time where they really don't like their parents or don't want to talk to them or don't want to listen to them. However, Maddie's like, she just loves Bo so much.
She hadn't done that yet.
She hasn't done that yet.
I'm hoping never.
I don't know if she would. I mean, this
you
would
said
be
she's 17, right?
She just turned 16.
She just turned 16.
Okay, so now is peak time. If
I
that
know,
hasn't
man.
happened yet,
And I mentioned it to her.
You might be in the clear.
Yeah, and I
you mentioned it.
I mentioned it to her. I was like, man, I hope, because I've got two girls, and I'm like, I'm prepared for there to be a period of time there where they don't want to listen to me at all. And I mentioned to her, I was like, man, I hope Una and Birdie are still have a relationship like you and Bo have at this age. And all she said was like, spend time with them. Just spend time with them. And you spend time with Maddie as much as you can, helping nurture whatever she does. And I do that with my daughters as well. Just as much time when you're there, be there with them, especially with the dad. When kids play with their dad, they get a release of whatever it is, oxytocin or
dopamine
or whatever it is. There is something with the dad specifically when they get playtime with their kids that releases dopamine or whatever chemical that really helps. And with the mom, it's a little different. They don't get that as much through play with the mom as they do their dad. So some scientific stuff that may be real, maybe it's not, but
it sounds good.
I saw it on a video, and the person definitely seemed to know what they were talking about. But that's something I've been so lucky. I know you're not asking for me, but just
no, I'm asking because you're twice as long in it as I am, more than that.
Sure. And I'm so lucky to have the perspective. I've just heard it from so many like aunts and uncles and others that talk about like how quick kids grow up, and it's true. Gosh, it's so true. And being present and with them and prioritizing spending time with them and doing what they want to do.
Yeah, what they want to do.
Do what they want to do. You know, here's this time is my time with you right now. We're doing what you want to do and just fully engulfing in that play. And that, of course, there's other things where it's like they're going to do what I want to do, or I want to show them this or whatever. But mostly it's like when the playtime comes, being with them and making sure you have that time with them. It's just, it's huge. It's huge.
It's so much easier said than done. Like, you know, you've got a 7-year-old, so you've been doing it for 7 years. But like I get home I always try to get home by 5:30 at the latest.
Yeah.
So you get home at 5:30, you know, you've got 3 hours, 2.5 hours, whatever it is. You just want to sit on the couch. So it's funny because I've heard this a million times, but then when you're actually in it, it's like, all right, he really wants to go play baseball. I just want to sit down and like watch my phone.
Yeah.
You know what I mean?
Right.
So it's so much easier said than done. But it also kind of makes me think of the conversation we were having earlier about like, you know, getting your business in a place where it's systematized properly. And like, if you're not a good delegator and you're not running a good business and you're stressed out and you're having to work till 10 p.m. every single night, that can be a badge of honor for like a period of your life. But I'm learning more and more. Like my dad actually told me this 2 weeks ago. He's like, you know, because I played this awesome golf course, and this one big shot I was playing with was on his phone the whole time. And like, you're not supposed to have your phone at this golf course. And my dad's like, you know what I've learned is usually it's the guy who doesn't even take his phone to the golf course who's actually got the best business.
Yeah.
But I'm like, that is such a good point. Like, am I at a place in my business or in my life where I can say, I'm going to go play golf for 4 hours and I'm not going to touch my phone? And like, the truth is that would stress me out, you know, but it's the same way with like my family. Like, am I okay shutting it down at 5:30, knowing that the world's not going to burn down?
It's not.
Or does my business need me because I haven't set it up properly?
Yeah. Yeah. It's, I mean, I tell you what, like being there, I mean, just making it a priority of, when I get home, I'm spending at least 30 minutes with my kids before I sit down, or, you know, maybe after 30 minutes of unwinding, going and like, especially at this time, Kevin, like they will grow up so fast. It can be, Bo and I both believe it's very like energizing and refueling to have that time, especially when you plan for it. Right. When I get home, there's at least 30 minutes where it's all Caleb, right? It's all Caleb. There's something that happens when you do that and you put everything away and you make it a priority to do that a couple times a week, at least. It's huge.
I'll tell you, man, I've had so many times where I get home, we have dinner, I'm sitting on the couch, and then my daughter will say, or the boys before her, hey, will you take me shooting? You know, like she wants me to rebound for her, you know.
Oh, okay. I didn't know what kind of shoot we're talking about.
Well, it could be anything.
So, and I'm like, I was like, and I'm thinking in my head, I really don't. But most of the time I do. And a lot of that has to do with Autumn. Like my wife, she really encourages me to just, you know, spend that time with the kids. I've never been not once ever have I been sorry that I said yes.
Yeah.
And it's because of that we have the relationship that we have now.
Right.
You know, we just spent four days in Cincinnati. She had an AAU tournament, just me and her. And we had a blast. Yeah. You know? And it's because of the groundwork of the previous 16 years that we weren't crossways once. That's just not the nature of our relationship. We had fun. She did well. She gave me a couple looks, you know, like, would you stop yelling so much from the sidelines? Kind of thing,
yeah.
But,
yeah. Yep.
You know.
That's right. I think my wife thinks I say yes too much. Not to like, can we have a treat or whatever. And this is just tongue in cheek, if I'm using that correctly. But like, if I'm available and I'm there and Una or Birdie want me to play with them, my default is yes. And if I can't, I can't. But my default is yes, whether I want to or not. And I'm really thankful for that because, Yeah, they are like, she's 7 now. It's crazy. And Birdie 3. It's crazy to me how quick that goes. And I'm just so thankful. Too, like when Una was 2, the pandemic happened. So I got this really special year, and we were in Chicago. So we were like strict lockdown.
Oh, yeah, we're locked down.
We had this year where we were all home and all together, and I wouldn't trade that for the world. That was a really special time that most people don't get with their kids, especially, the ones that are working. It was, I'm really thankful for that. But I think that really helped me too, to really think about it and be like, man, this girl's used to me always being here and always being available. And now, things open up and it's switching, but I always want to be there when I'm there. So it's huge. It's huge.
But just to put a kind of a bow on this idea, you decided, that's not what I meant. You decided at age 22 that you wanted to start something you were passionate about, so you did. You didn't let your age hold you back. And so you jumped into this entrepreneurial world, and you've had a lot of success so far. And it's very impressive. But the reality is you're the entrepreneur, you're the boss. You decide what your business looks like. You decide how much time you spend with your kids and your wife and your family. And you, more than anybody else, or I should say we in this entrepreneurial space, more than anybody else, we might feel the pressure of running a business and the impact that it has on so many other people, but we get to decide exactly how we spend our time. And so just like you didn't allow your young age to hold you back when you got started, I'd encourage you to lean into the freedom of time that you have and spend it exactly like you want to and like you believe you should. Like you've got the ability to do that. And I spent a lot of years feeling like I had to get to the office at 8 and we'd leave at 5 generally. Mm-hmm. But because of my military service, because that's kind of what Dad, he'd work till 5 and go home. Like I felt constrained. It took me a long time to decide like, man, I'm actually the boss. And I still generally work from 8 to 5. That's my norm. That's just what feels right to me. But now I'm starting to work out at lunch instead of in the morning. And I'm starting to take more days off to go on a trip with the family or to do something.
Do you know what really helps with that? A virtual executive assistant. You can go to superpowers.com superpowershq.com/commercially speaking. Go get you one to change Bo's life, as you just heard.
That's exactly true. Yeah.
Great.
And they're one of our sponsors.
Yeah. We love them.
Way to work that in there, Timmy.
Yeah.
Yeah.
That was perfect.
Yeah.
Hey, as we wrap this up, share with our listeners where they can go to reach out to you and learn more about Rockbridge.
Easiest thing is probably just our website. It's just www.rockbridgeinv as an investor.com. I think that's probably the simplest, and I could throw my email out there too. It's just kevin.dean@rockbridgeinv.com. Besides LinkedIn, I don't have any social media, so I'm not putting any posts out, but so those will probably be the two best.
Yeah. Okay.
Great. Anybody want to get connected and see more about what they're doing or maybe get involved in some deals? rockbridgeinv.com or email the man directly, kevin.dean@rockbridgeinv.com. I believe that's right.
And Timmy, one other thing on that actually, now that I mentioned, we actually do a newsletter.
Nice.
A quarterly newsletter.
Great.
So one of my business partners, former equity research analyst at Stifel, covering all the REITs. So he was putting pieces together on a weekly basis. And I used to be doing our newsletter until we brought him on full time like a year ago. So he is a way better writer than me, and he puts very detailed quarterly newsletters together where we go deep on the economy, our current assets, all that kind of stuff. So if you go on our website, there's a way that you can subscribe to our newsletter, and then you can also obviously just email me and I'll add you to it.
Oh, fantastic.
Alice,
quarterly newsletter.
Alice, will you sign me up for that?
Gotcha.
Thank you.
Nice. Isn't that great having a virtual executive assistant? Alice is, we love her so much. Well, Kevin Dean, this was fantastic.
Yeah.
Yeah.
Great conversation.
Yeah,
we really appreciate your time and coming on. And
yeah.
Yep.
Absolutely. Thank you so much.
I appreciate you guys having me. This was a fun conversation. I learned a ton from you guys too. So would love to keep the conversation going.
Let's
For
go.
sure.
Go. We'll definitely have you back. We'll definitely have you back.
Awesome.
Yeah, we don't want to keep you any longer. Thank you so much.
Yeah, man.
Thanks, gents.
Yep.
Talk soon. Have a good one.
Thanks so much.
Bye.
All right.
If you made it through this episode without opening a retirement account or questioning your life's purposes, you're either Kevin Dean or lying.
If Kevin helped you rethink how you work, invest, or lead, subscribe to the podcast, share it with a friend, or better yet,
Leave us a 5-star review on Apple Podcasts. We don't ask for much, just validation. 5 stars and a gentle head nod from Barbara Corcoran.
and sign up for our newsletter at subscribe.wgbaron.com. Every week, we send out new episodes and curated content on leadership, business strategy, negotiation, basically everything I read that Timmy should be reading.
It's like Harvard Business Review, but with fewer payrolls.
Have you ever read Harvard Business Review?
I have not.
Me neither.
Also, if your to-do list is becoming a hostile takeover,
Or your inbox is starting to qualify as a historic preservation site.
then it's time for you to get yourself a virtual assistant. Go to superpowershq.com/commercially speaking.
They'll help you delegate the chaos so you can get back to the high value stuff like closing deals.
Or explaining cap rates to your cousin at Thanksgiving.
Sure.
Yeah. Again, for those in the back, that's superpowershq.com/commercially speaking. And finally, Barbara Corcoran. If you're out there, I still don't need your money, but after talking to Kevin Dean, I'm starting to realize I might need a mentor. Not a shark, just a dolphin. A wise, supportive dolphin in a power blazer. Barb, I don't want to pitch. I just want to walk through a deal, hand in hand, into the sunset of a well-diversified portfolio.
We need to write off that metaphor.
Yeah. Thanks for listening. Subscribe, follow, review, and we'll see you next time on Commercially Speaking. I love you, brother.
Love you, brother.
Bye, Alice.
Bye.
Yay!
I'm excited, Bo. I'm so excited.
Awesome. Love it.